Hello friends, this is Hatim Rampurawala, and in this video we will cover essay 540, the 540 revised, that is auditing accounting estimates, including fair value accounting estimates and related disclosure. So in that, our first point is objective of the auditor: to obtain sufficient appropriate audit evidence whether the accounting estimates, including the fair value and the related disclosure in the financial statements, are adequate. Okay, so you got what is the objective? That is to obtain sufficient appropriate audit evidence whether this accounting estimates and the fair value accounting estimates are reasonable and their related disclosure in the financial statement are adequate. Then it has been divided into two parts, that is the meaning and the nature of the accounting estimates, and second is auditor's duty. So we'll first accounting estimates. Accounting estimates, it is an approximation of the monetary amount in the absence of the precise amount of the precise means of measurement. In absence of precise means of measurement, this term is used for an amount measured at the fair value in where there is an estimation uncertainty. Okay, so accounting estimate is an approximation of the monetary amount in the absence of the precise means of measurement. This term is used for an amount measured at the fair value where there is estimation uncertainty. Now, what is the estimation uncertainty? The susceptibility of an accounting estimates and the related disclosure. Now, susceptibility means what we can say, chances. The chances of an accounting estimates and the related disclosure to an inherent risk. Now, there is basically an inherent risk of precision in its measurement. Precision, that is, we can say error. So the susceptibility of an accounting estimates, susceptibility of the two things, that is accounting estimates and the related disclosure, to an inherent risk of precision in its measurement. The susceptibility of the accounting estimates and the related disclosure to an inherent risk of precision in its measurement. That is, there is an inherent risk of error in the measurement. You can read out as to an inherent risk of precision in its measurement. Then there are examples of an accounting estimates, and why I have read this again and again, so that it automatically get mug up also the meaning, so we can easily write it in the exam. Then the examples of the accounting estimates, these are much simpler, that is provision for the doubtful debt, then inventory loss, then warranty obligation, depreciation, provision against the carrying amount of the investment. We'll read out again: a provision for doubtful debt, inventories, what we can say, depreciation, warranty claim, and provision for the provision against the carrying amount of investment. We say what we say, investment diminution in the value of investment, that is it, that is provision against the carrying amount of the investment. Then examples of the fair value accounting estimates, first is share based payment, asset held for disposal. Share based payment is India's Ind AS 102, share held for assets held for disposal is 105, financial instrument 109, and assets acquired in the business combination 103. So there are four India's references: share based payment, then assets held for disposal, financial instrument, and assets acquired in the business combination. In all this, we require there is an estimation, and that we have to measure at the fair value. So it is fair value accounting estimates. And then there comes as auditor's duty. In this, it has been divided the risk assessment procedure and the related activity, and the second is responses to the assessed risk. So what is the risk assessment procedure? In risk assessment procedure, what auditors generally do is obtain an understanding of the business and its environment. So if we talk in relation to this essay, there is essay 540 in relation to estimates. So what it will be like, obtain an understanding of, first, the requirement of the applicable financial reporting framework, that is how the FRF says to account for and disclose the accounting estimates. So we have to obtain an understanding of the requirement of the applicable financial reporting framework. Second, how the management identifies the transaction, events, or the condition that give rise to the need for the accounting estimate. So what are the transaction, events, or condition that gives rise to the need for an accounting estimate? The need word is important, that gives rise to the need for that such a transaction will need the accounting estimate basically. So how the management identify the transaction, event, or the condition that give rise to the need for accounting estimate. And the third, auditor has to obtain an understanding of the estimation making process, that is how the management make the estimates basically, estimation making process adopted by the management and the data on which they are based. So estimation making process is the methods and the model used in making an accounting estimates, related control, use of the management expert, change in the method. So if there is any change in the method from the prior period, there is change in method of an accounting estimates from the prior period, then along with the reasons of the change, audit has to understand basically. So this is an estimation making process. There is methods and models in making an accounting estimate, related control, then related not internal control, related controls for the accounting estimates, then use of the management expert, change in the accounting estimate methods, and along with the reasons and the assessment of the effect of estimation uncertainty. So what will be the effect of the estimation uncertainty, assessment of that. And the second thing, so first what he has done is obtain an understanding of this applicable FRF. Second, how the management identifies the transaction, event, or the condition that gives rise to the need for an accounting estimates and estimation making process that we have seen. And the second point in risk assessment procedure is review the outcome of the accounting estimates of the prior period. So what it is, review, the auditor will review the outcome of the accounting estimates of the prior period. Okay, then it is responses to the assessed risk. In that, so it is what we have studied in 315, that is and responses is 330 basically. So of the risk assessment procedure, see, it is response. So what are the responses of that? There is further audit procedure. So whether auditor have to check whether the management has appropriately applied the financial reporting framework. See, over here they have obtained an understanding of the requirement of the applicable financial reporting framework. Now they will check whether the management has appropriately applied the financial reporting framework. Then secondly, they will check, see, in the estimation making process we have seen the methods, model used in accounting estimates. So they will check that whether the methods are reasonable and whether they are consistently applied. So in this point also we have seen the fourth point, that is change. If there is any changes from the prior period, so they will see the reason and that method of making an accounting estimates, whether it is consistently or not, and if it is not, then what are the reasons. So that he will auditor will assess in responses in this his response basically. So responses to the assessed risk. Based on the assessed risk of material misstatement, auditor shall determine first whether the management has appropriately applied the applicable financial reporting framework, as I discussed. See, over here it was in obtain an understanding of, and now whether the management has appropriately applied the applicable financial reporting framework. And second, whether the management has whether the methods are appropriate. See, over here in first point we have seen whether the methods are appropriate. So he will determine, auditor will determine whether the methods are appropriate and have been consistently applied. Okay, now it has been divided into two, that is general responses to the assessed risk of material misstatement and specific response to the assessed risk of material misstatement, or specific response to significant estimation uncertainty. So now first we will see the general response to the assessed risk of material misstatement. First, determine whether the event occurring up to the date of an auditor's report provide the audit evidence regarding the audit evidence. So here you have to assess, you have to check, determine that up to the date of an auditor's report, that is after the balance sheet date and up to the auditor's report, whether there are any event or the report that provide the audit evidence. So whether any event has occurred that provide the audit evidence regarding the accounting estimates. Then test of two things, that is first, test how the management has made the accounting estimates and the data on which it is based. So auditor have to test how the management has made the accounting estimates, see what you have seen, estimation making process. So they will test how the management has made the accounting estimates and the data on which it is based, and they will test the operating effectiveness of the controls. See, over here we have seen the control thing, this in estimation making process. Second point, relevant controls. So they will test the operating effectiveness of the controls. So what 3 point we saw, first is events occurring up to the date of an auditor's report provides, determine whether any event occurring up to the date of an auditor's report provide the audit evidence regarding the accounting estimates. Second, test how the management made the accounting estimates and the data on which it is based. Test the operating effectiveness of the control. And fourth, auditor has to develop a point estimates or a range to evaluate the management point estimate. So auditor will basically develop a point estimate or a range to evaluate the management, to compare it with or to check with the management point estimates. So these are the general response, and the specific responses are okay. this first to the estimation uncertainty. First, evaluate whether how the management has considered the alternative assumptions and the or the outcomes. So how the management has considered the assumptions or the outcome, auditor have to evaluate that. Then how the management has addressed the estimation uncertainty in making the accounting estimates. So first is how the management has considered alternative assumptions and outcome, because there would be many alternatives in front of management, from which they will choose one or they will apply one basically for an accounting estimates. So how the management considered alternative assumptions or the outcome. Second, how the management has addressed the estimation uncertainty in making the, so how they have addressed, how they have answered, how they have addressed the estimation uncertainty in making the accounting estimates. Third, whether the significant assumptions used by the management are reasonable. So the significant assumptions which the management has made, in first point we have seen okay, how the management consider alternative assumption and outcome. So they have selected one, how the significant assumptions used by the management are reasonable. So we have to check whether they are reasonable or not. Then the fourth point, whether they intend to carry out the specific course of action management, and to evaluate, basically heading is evaluate the management intent to carry out the specific course of an action and its ability to do so. So auditor will check these four things. He will evaluate following things. That is, first, how the management has considered the alternative assumptions of the outcome, how the management has addressed the estimation uncertainty in making an accounting estimates, whether the significant accounting assumptions are used by the management are reasonable, whether the evaluate whether the management intend to carry out the specific course of an action and its ability to do so, whether it has an ability of carrying out or to do so that act, then specific course. Then the second point, if the auditor's judgment management has not adequately addressed of the estimation uncertainty. So if the in auditor's judgment, if management has not adequately addressed the estimation uncertainty, so auditors shall develop a range. In fourth point we have seen, develop a range estimate the range to evaluate the management point. So that's what they have given, that auditor shall develop a range with which to evaluate the reasonableness of an estimation uncertainty, sorry, a reasonableness of the accounting estimates. So auditor shall develop a range with which to evaluate the reasonableness of the accounting estimates. Okay, so we are done with this essay 540 in essay 550. Okay, thank you for watching the video.